Good afternoon, ladies and gentlemen. Welcome to probably the last of Market Gurus episode for 2024, and this could well turn out to be the most important one. Our guest for today is Mr. Maneesh Dangi, CEO and founder of Mosaic Asset Management, a very well-known cyclical investor who spent considerable time in Indian equities and does a lot of global macro. Not only will we be quizzing Mr. Dangi about the prospects of 2025, but we will look at a lot of grey clouds that are hovering on the Indian equity landscape. Namaste Manish ji, and a very warm welcome. I believe you are in Udaipur, where you must be enjoying the winters as much as I am enjoying in Delhi. A very warm welcome to you, sir, and a happy 2025.
Happy 2025 to you, and a pretty cold day in Udaipur as it is in Delhi that you can see.
Yes. Yes, sir. Manish ji, the also cold part of this weather has, put Dalal Street also on the back foot. Since September, we've seen heavy profit booking. Our foreign friends are going back to their US shows. Rupee is at a record low. Forex reserves are dwindling. The economy is slowing and inflation is on a rampage. It's an unholy mix of anything and everything that could go wrong, right being in front of us over the last 3 months. How do you see 2025? And is this an year where equity investors will make money for the 10th year in a row?
Okay, so on markets, Shailesh, I've had this view for 3-4 months. We've discussed this that rather tumultuous, slow lane, little returns out there in markets given valuations, given macro that we've been in. So my view sort of remains same that you know even before we sort of start doing a sort of a big picture analysis of macro and markets, the key message to the investors would remain same that keep the testosterone and the adrenaline low for 2025. It's time to be sort of be cautious. This yet is going to be a year which likely going to disappoint markets as it has happened in last 3-4 months, 5 months now. So that's a very, very big picture general view on markets, particularly for the equity investors. I think there are reasons for it. So if you do a little bit of a global survey, you realize that even though US economy is doing decently all right, there are very few chinks here there, but otherwise US economy is doing all right. Europe and China have been struggling through and through 2024 and unlikely to recover in a meaningful fashion. And what sort of India has jumped into that slow lane. It is no more speculative, Shailesh. What we were discussing 4-5 months ago that India could enter into slowdown. I think, it's pretty evident that all sort of signals are out there suggesting that India is slowing sort of pretty rapidly. You look at tax collections, both GST and corporate taxes, are in single digit growth now. The credit growth, which was very buoyant about a year ago, is now coming close to 10%. You all markers of consumption growth, be it PV sales, be it housing sales, or staple growth, discretionary consumption in India, all of them are sort of quarter on quarter decelerating. Now this is nothing unusual. As anything happens to markets, economies also go through boom bust. So I think this slowdown which is underway is yet to sort of fully play out over the next 5-6 months. So in a sense it's sort of cliche, but 2025 you will see as next 6-8 months of actually we struggling with slower and slower economy until we come to a point that US too actually slows rapidly and blesses us with the potential to cut rates sharply or perhaps do some fiscal. Until some kind of an external support come, Shailesh, it's very likely that we'll continue to have a rather weak macro setup. And in that, you really don't make much money in equity markets.
So, Manish, what ails the economy? Is this something that the decision makers failed to read? Or is it just that the government capex slowed down because of elections, because of erratic monsoon, whatever reasons there might have been? But did the policymakers not anticipate this rapid deceleration in Indian economy?
I don't think that then that you can accuse policymakers and more specifically RBI to be ignorant about it. Okay, they were well aware of it, but we must admit that as an emerging market work with a lot of constraints. In a setup in which dollar is strengthening, and that US rates are as high as they are today, it's very easy, very very difficult to sort of loosen up on interest rates in India. So that's one. Number two, RBI also saw that over last 4 5 years, more so after COVID, the financiers actually grew very very rapidly, and in that setup, basically what really happened was that some of the unsecured finance started to see stress here and there, and RBI had to actually as a precautionary measure, lest that we get into another 2015-18 kind of NPS stress, actually had to clamp down. So therefore, RBI perversely actually ended up tightening policies instead of loosening. So in some sense, even though they were well aware of what was happening, the other constraints actually ensured that they do not ease up rates. From the fiscal side, Shailesh, I think the potential to ease up is not there at all in India, because the public debt has risen quite sharply. And until, of course, US and many other countries do the fiscal stimulus, Indian policymakers have very little fiscal space to actually loosen up further. So it's kind of, constrained environment is the reason why policymakers couldn't do anything significant, even though it was very evident to all of us that Indian economy was slowing 6 months ago.
Okay, fair point. Now, this is in the past, and of course, we can do pretty much nothing to change and go back in time and maybe rectify it. But we can surely, tweak our sails to sort of either readjust to the wind that is blowing, or maybe pull the sails down and rest in cash. So, for 2025, Manish bhai, what are the 2 or 3 sectors or asset classes that you think will relatively outperform uh, what they've done in 2024?
So, equities, I'll give you cuts. Okay, so I kind of think of Indian equity as three sectors. One is BFSI, second is local capex, or rather capex, and third is consumption. So BFSI, I think the peak regulatory tightening is behind us, and things will ease up. So to that extent, I think BFSI can do reasonably well. Within BFSI, actually, I don't like the wealth businesses because they are too expensive, and it's likely that we will enter in a little bit of a weak wealth growth environment. So therefore, that's not the part that I like. Financing part I like, but within that, actually, I like the non-retail more than the retail. So if some franchises are pure retail franchises, some of the large NBFCs, some banks have been doing only retail, and some which are overweight wholesale finance, I think the latter is what I like. So that's the one part of markets. Okay. Second part of the market is capex. I think Indian local capex is obscenely priced, exorbitantly priced, and I think it's avoidable. I don't see any significant signs, LSD, of a growth in capex in a meaningful fashion. So I would avoid it. And the global capex proxy in India is Indian IT. So both Indian currency weakening, as well as, given that we've recently had a bust in IT in 2022, there is a reasonable case to make that global capex proxy like IT could do reasonably well. And if the currency weaken, actually it's an icing on the cake. So that part I like. Within consumption, I think I don't like the discretionary consumption in India. That is likely to stay weak. And whereas the staple consumption or the non-discretionary consumption has had a 9 12 months of slowdown already, even though they are expensive, purely from a macro point of view, at margin, things can get better there. So that's how sort of I think, at a sector level, one should sort of look at. And then finally, at a cap level, of course, India is just the opposite setup of US. US is the mega caps, hyper expensive, and the median US company is still 14 15 times of forward earning. India is just the reverse. Actually, the mega caps are relatively cheaper versus the median company, which is obscenely priced at 45, 50 times of forward earnings. So I think investors are best placed to hide themselves in mega caps in India. Just the reverse of what they should be doing in US.
Fair point. So, for those who have an international exposure and have made a lot of money in the top 7 Nasdaq and the top 10 S&P 500 companies, primarily in the internet space, Manish has a view that they look overvalued, and our large caps, especially the top 10, are relatively undervalued. In fact, they haven't done much over the last 6 months as well. So, Manish bhai, this is the ninth year. 2024 is the ninth year where we've made year-on-year returns on equities, a bit of a record, and the last 3 months have shown us the potential of what a tired bull looks like. For 2025, if you look at the large cap space, what kind of return would you foresee over the next 12 months? Let's just limit ourselves to the 20 super large caps.
So, before Diwali, I sort of made a promise to you that next Diwali, when we meet, most probably index will be flat or negative. Sort of, even though some gains have been given up, I still think that Indian local investors are euphoric in terms of valuations. Shailesh, look around, Indonesia is 11 times forward, China 10x, Korea 7, 8x, Brazil 7 times of forward earnings, India at 22, 21 times, very expensive. So this Indian and US exceptionalism, okay, will we will have to demonstrate to the world that India grows at 7%, and what is likely to happen is that India will likely grow at 5.5% over the next 12 months. So my sense is that we are against this basic narrative that we built for ourselves, that we are exceptionally strong economy, and what this data is suggesting is that perhaps we aren't, and to that extent, it's more likely than not that India disappoints. Now, let's say Nifty level, I continue to believe that we perhaps would be flattish for the year. So there's kind of a time lapse and a loss of kind. But as a matter of fact, markets are never flat, right? They are very wobbly, volatile, and if investors don't get what they want, they will freak out at times, and so therefore this year is going to be more like 2022, more volatile than 23, 24.
Okay, fair point. But pockets of excellence and pockets of outperformance are something that you and I and a large chunk of the market are very familiar with. You've mentioned large caps, and you've also mentioned the IT space that might do well. But what's rallying and rallying very sharply is domestic pharma. Is this a space that you like? Old world favorites, Lupin is coming back after maybe 10 years. Cipla, Sun Pharma, stocks that we used to talk about. See, you're smiling. In 2004, 2005, are back into action. Dr. Reddy's and maybe even Divi's are trimmed and are running as they used to maybe 2 decades ago. Is this a space that you like? And within pharma, what could be an outperformer?
So, in a sense, in entire Indian manufacturing, especially the traded commodity, you have a massive China threat. But pharma remains one such place where we have some comparative advantage. And to that extent, it's more for large fund managers, where so much money, local money is sloshing in the funds. It kind of is a little bit of a place to hide. It's more like a defense play, so to say, instead of an offense play. And so to that extent, I think if you're a manufacturing, if you were to, so in India, generally, I advise people to be long services, which is IT, BFSI, wealth, and all sorts of businesses versus manufacturing. But within manufacturing, pharma perhaps is one place where you have a little advantage, and your position is not likely to get threatened in a meaningful fashion from China. So to that extent, it's a place to hide. Is it going to grow gangbusters? I likely no, but it still is a place where there is a decent valuation buffer, and the macro is not as bad. So which is why my sense is that you could still expect reasonable. Same thing you could say that for Shaileji staples also. They're still very expensive. And a 2-3%, 4% of volume growth of Unilever and Nestle's of the world, they don't seem like great value. But relative to past, they're better valued, and at least that's a space which is not likely to see the fall that you may see in the discretionary and many such capex which are obscenely valued relative to the past. So in some sense, these are all relative trades we are taking. There are very few absolute trades available. When the markets rally for 9 years, it's pretty much well discovered, or rather fully discovered. So it's a time to sort of find defenses in the portfolio instead
Yes.
of looking for offenses.
Yes, I agree with you in totality. Like Manish bhai, what has happened here is that uh, I think private consumption has also been squeezed by the fact that most of the middle class has seen stagnant to flat salary growth and has aggressively invested in this mutual fund space. If we were to total the amount of money on a net basis that foreigners have taken out, and if there were no retail investors, Nifty would have been 14,000. So this issue of private consumption being squeezed, how do you sort of correlate it with rising monthly fund inflows, skyrocketing valuations in small caps and mid caps, and here we are grappling with the fact that staples are not doing good. Matlab dal, roti, atta, chawal, chini, sabun, toothpaste is at 4%. I can't believe it.
So I'll give you a sort of very basic caricature of the guy who's investing in mutual fund and the guy who's actually buying stuff. Okay, the guy who's investing is middle-aged man, of yours and mine, who's already bought a house. He's had children, gone to college, but his salaries and the income is at the peak level of his lifetime. He's most probably nearing 50 right now. Has a lot of excess saving right now. But having bought a house, fridge, TV, and everything else, what does he do with the money? So that saving, a lot of it is financialized. So in whichever country the 45 to 60-year cohort of population actually grows after a certain point of per capita income, financialization of saving happens. So that is what has been happening in India for last 8-10 years and will likely to continue to happen over next 20 years. Okay, understood this, that this is the part which is driving the financialization of saving. Okay, now the guy who actually buys stuff is not the 50-year-old man. Okay, the guy who buys stuff which is toys, roti, kapada, makan, lots of new things, cars, this, that, is a guy in 30s. Okay, the guy who just had a child. So in a sense, these are two different cohorts. That guy is actually the latter one is actually struggling because the jobs are not there. There is a stagnation in income. He's not able to migrate higher, and so that guy has been struggling. So it is so perverse, but you can continue to have wealth boom in India even though the parlays don't sell well. So that seems so contrasting, but because the guys who incrementally buy Parle-G and the people who buy SIP are two different sets of people, and they can behave independent of each other.
Yes, absolutely. I stay near Gurgaon. Flats above 100 crore rupees are selling like hot pies, and those below 2 crore rupees are going a begging. This discomfort, this how should I say, dichotomy is very well expressed in how national elections have panned out, how people are expressing their anger by coming on streets, and this incessant news that we hear about CEO salaries going up by 50 times and average salaries just maybe meandering where they were. Be that as it may, yours and my job is to sort of find values of outperformance, like I said earlier. You've mentioned large caps, you've mentioned IT and some extent pharma. So, and of course FMCG. So are we in the market of 1990s? These were the three themes that used to work very well from say 1991 to 2000, when we just worked excessively on the likes of Lever, ITC, Nestle. Bonds used to be listed. So was Brook Bond India. Pharma, of course, you've mentioned, and of course, IT. So, is this life coming back to a full circle?
Listen, the thing is that you, even though you want to draw parallels with 90s, these are 3x more expensive than they were then. Uh, so they are much pricier today than what they were then, and therefore at these prices, we've seen what has happened to Asian paints, right? When you buy something very expensive, where the macro and tailwind support and tailwind of growth is not there, what ensues for you is years and years of no returns. Howsoever great a company is, and howsoever great the ROE
Hmm.
of a firm is, and operationally efficient it could be, it actually still does not deliver. So, in a sense, listen, Shaileji, we are trying to look for places where we can hide. If it's raining heavily, you will get wet. It's just the certain places where you perhaps will not get as wet as possible. Think of like India defense. What has happened. Something similar could happen to a lot of Indian manufacturing plays, hyped up as if there is a massive competitive advantage has opened up because of China plus one. But then we are sort of increasingly witnessing that the real growth, the potential is not converting into the opportunity and growth finally. So therefore, a lot of these hyper expensive, Indian manufacturing assets could actually see a lot of disappointment. So many mutual funds have actually launched these thematic assets, where they've deployed money at very high valuations. I made this point many times in the past also, that most of those investors won't even earn bond-like returns for 5, 10 years. So again, going back to the rather somber note for 2025, that it's a time to buy umbrellas. Again, play defensive, don't be offensive, be a little underweight equity if you can. Within equity, as we've discussed, certain places where there are places to hide, which are more global in nature and maybe hyper local, which is staples. But stay away from hyper expensive asset class, small and mid caps. Hide yourself in large cap. That's how, and maybe a little bit overweight in bonds. There's a decent chance that last year also bonds delivered very well.
Yes.
Next year also most probably bonds will deliver most likely 9-10% returns. I don't think Nifty is going to deliver that much return. So why don't you sort of hide yourself in bonds and be at least incrementally be overweight bonds than equities.
Yes, this is a point that you've mentioned in your last interview with us as well, that sovereign bonds will probably outperform equities. And it seems that this might be what is most likely to happen in 2025. So, a good bond fund, ladies and gentlemen, with a long dated tenure would probably be making more sense. This change of guard at the RBI, is this something that might turn the tide? Corporate India, as well as large parts of the economy, is actually looking for a rate cut. Do you see that happening in February, or should we wait till April?
I kind of think over next 12 months we should see 100 basis point rate cut. Okay, so that's my view. Right now, the biggest challenge for RBI is to deal with rupee. Uh, Mr. Das actually for good 12 months, was protecting currency. And in some sense, a lot of market participants are critical of the decisions that were made then. Uh, for corporate India, actually, the weak currency right now is a better way to sort of protect it instead of cutting rates. That's the first stimulus that you could give, because that brings competitiveness to you, right? Especially in manufacturing, it doesn't matter much to the services though. So I think the first reflex of the new governor is to let go of currency, and which is why we've seen a rapid depreciation. I think it's more likely that we behave like China, or perhaps even worse than China in terms of currency depreciation over next 12 months. And there's Indian exceptionalism in terms of our currency performance actually will stop. And that is the first stimulus that I'm looking for from RBI. Second thing, which all of us, would want at some point in time is that RBI loosens up a little bit in terms of their guards with respect to unsecured finance. policy tightening has been extreme, and to some extent, access to money itself has become very difficult for small financiers. So I think loosening up a bit there actually is second demand from the corporate India. Finally, rate cuts, would come in. That's more like a global macro proxy. Its impact is shallow in India. So I'm not that. This is not as if I were a CFO of a large company or an NBFC. I would rather have loosening of, regulatory constraints and actually letting go of rupee instead of, easing up rates. So in terms of priorities, I still need the first two things done. Then the rate cuts come. Your question on rates, it's almost very, very certain that India will have to cut rates. We need to cross January though, Shailesh, because we have a Trump coming in, and we frankly don't know what sort of tariffs he will impose, and would
Yes.
India also be part of that trauma? I hope it is not, and but if there were to be sort of major tariffs, in Indian services or otherwise, the rate cuts actually somewhat become untenable, at
Ah.
least in near term.
Yes, and that brings us to this hotly debatable topic of Mr. Trump now being in charge of the world's largest economy, and coming into play when a lot of things there are pretty worrisome, including the debt and, of course, the uncontrolled spending. Manish, how do you see Trump uh, as an arbiter or catalyst for US economic growth, therefore their markets, and therefore the fact that Indian stocks will also rise, because we've had a very strong correlation with Wall Street over the last 20, 25, 30 years.
So this Trump, is somewhat different from the first Trump that we saw, because he comes with this, Elon Musk embracing him. And so to some extent, he is likely to be more conservative in terms of fiscal spend. Okay. Is likely to be as aggressive as he was in the first term with respect to corporate tax cuts. And so, whatever is expiring in near term will get extended. So this Trump is more about productivity. It's a techno nationalism. It's likely, and I know we all must fear that what if they become friends with China? If he strikes a great, he's a deal maker in the end. If there were to be a deal with China, to some extent we are actually worse off. Um, its impact on India is the channel is primarily currency. And we need to negotiate for ourselves that our services do not get major tariff hikes. So that will be unfortunate if it happens. But otherwise, currency is a key channel. If currency were to weaken sharply, it will postpone the rate cuts in India. So to that extent, Indian bonds will actually have to take care of that part. Which is why you've seen in last 1 2 months, there's sort of a quietness in the Indian bond market. We haven't sort of given up gains that the way U.S. Treasuries have given back. But there is a little bit of a somber mood in Indian bond markets right now. We all are like waiting and watching at least until Trump comes and announces his policies. Generally speaking, I think Trump is anti-war, so
Okay.
it is very likely both in Middle East and Europe, we will get good news. And to that extent, Trump, could unleash lower crude for us, which is sort of positive India inflation. So on net, I kind of think that Trump is positive versus an alternate, we would have had. But it's not sort of in like out and out positive. There are many moving parts. It's sort of worth watching out for next 12 months, next 1 or 2 months as to what his actions are with respect to Indian tariffs. Before we take the big call on Indian bonds.
Okay. Manish bhai, my final question to you: at what level and till what time would you be comfortable with the value of the rupee?
I think on a real basis, rupee is still about 3 4% expensive. So I think we can give up 2 3 buck further. I don't think look, Shailesh, most countries celebrate weak currency. India somehow, for some odd reasons, of course,
Yes.
for political narratives and such likes, despises weak currency. I think, a steady depreciation and a competing depreciation where we depreciate a little bit more for an emerging market is a cool thing to do, and I think it's a good news for most investors. We all are primed because of the political narratives. It's good that we get to 87 instead of stay at 85 in next 3 months.
Fair point. So 87 in 3 months is what will make Manish Bhai happy. And of course, safety in large caps. Be wary of anything which is overpriced, especially mid caps and large caps. Local capex is obscenely priced and avoidable, but Indian IT, which is actually a proxy for global capex, looks good. Pharma is okay, and of course, within the financing space, you like non-retail and wholesale finance. I hope I have summed it up as brilliantly as you put it, but thank you so much. Enjoy Udaipur, and of course we'll reconvene in 2025. Till then, have a nice holiday and enjoy what markets throw at us. Thank you, Manish Bhai. What a pleasure.
Thank you very much.
That, ladies and gentlemen, was Mr. Maneesh Dangi, a very cautious and probabilistic investor who looks at time cycles and of course does a wonderful job in allocating assets over money. He is very hopeful that bonds will outperform equities in 2025. Within equities, large cap is a space where you should be, and of course Indian IT, which is a proxy for global IT capex, looks good. Pharma to some extent is nice as well, but large parts of the market continue to be overpriced and expensive. Thank you so much for watching. I hope you enjoyed the conversation as much as I did, but continue watching Business Today Television. There's a lot of exciting things happening on the other side of the break.
Hello and welcome. You're watching Business Today Television. I'm Sakshi Batra, and this is yet another year-end special interaction that we're going to be having with a top market master for all of our viewers on this New Year and year-end specials. Remember, the Indian equity markets so far in 2024 have had shown a lot of resilience for a major part. We've faced so